Thank you. Thank you.
Before we get into what you're thinking now, just for our viewers, how do you structure the trades? How did you do what you did for that $1 billion day?
Well, I can't get into too much details about that, but the way
Can you give us the framework, if not the mechanism?
The way I invest is with extreme asymmetric payoffs, which means I want to, very infrequently, I want to have a huge payout. And most of the time, I want to just kind of bob around, maybe lose a little bit.
Sounds like the options market is your way to go.
Well, of course, yeah. I own way out of the money puts, to put it very, very, very basically. And this is, there's an insurance-like protection.
You're betting on, you're betting big on, you're sort of betting everything you've got on the Browns winning the Super Bowl.
Yeah, but the key is the payoff. The key is, what does the market charge you to do that? And what's the market's expectation of the thickness of that tail, if you will?
The cheaper the bet, the bigger the payoff if it actually does happen, because right? I mean, that's basically what
yeah, and the less you're going to risk to take that bet.
So, but you got to have the capital also to lose money on the 99% of bets that are not going to pay off.
Yeah, but the idea of this is sort of, insurance is there, so presumably so you can do something risky that you wouldn't otherwise do.
So what's a black swan today, do you think, in the markets?
Yeah, the easy answer to that is it's a huge crash or it's a collapse of this bubble that's been building.
Well, what's the precipitating factor?
The precipitating factor would, the ultimate cause of that would be the fact that the central banks got us here in the first place. Ultimately, my view is that central banks are the cause of bubbles.
So you're betting essentially that the central banks, whether it be the Fed or the ECB, whoever, they can't unwind the trade that they put on years ago.
They can absolutely can.
It's going to be a messy unwind for their trade.
Yeah, there's no doubt. There's no doubt about that.
But is that really a black swan? Because you've got all these people delivering alpha talking about it. So isn't a black swan supposed to be something that nobody is talking about?
Yeah, that's not a black swan. It would be
a Godzilla attack on Tokyo out of the blue or something.
Yeah,
like
so it's great that everyone's talking about this now. I had a little less company a few years ago when this was sort of building, and now it's so obvious. The casual user has become an addict, and now we're concerned about this, and that's great. But you're right, it's not a black swan. The reason I'm going to still call it a black swan is because the markets still price it as a black swan.
The fact that Fed Funds Futures is pricing only a 30% chance right now, approximately, of a September rate hike, that's basically telling you the markets will be caught completely off sides if that should happen in September. That could effectively be a black swan in of itself in some form, couldn't it? Just because the markets are not positioned for any sort of a rate hike anytime soon.
The markets are absolutely not positioned for this. There is this sort of collective psychology that says that the Fed can keep this thing going, that the Fed is in control. But in fact, central banks are not in control. In many ways, central banks are the tail wagging the dog. We think that central banks are so big relative to the market, but in fact, central banks are tiny relative to the market. Central bank balance sheets are 20 trillion. The whole global securities and derivatives market is a half a quadrillion. So in fact, the central banks are minuscule compared to that. So the only thing they have going for them is this sort of collective psychology. It's an illusion of control.
Asymmetric bet that you're putting on to reflect this, does this focus on the treasury market, or does it focus on equities? Do you think all asset classes go down in this scenario?
I focus very much on the left tail, systemic left tail of equities.
Okay.
But to answer your question, yes, I think all assets are very much correlated. I think there's just one big bet out there. So, diversification really isn't going to work. Timing this is not going to work. Remember, the equity market has extreme duration now. These low rates and this high valuation means that they're extraordinarily sensitive to changes in rates, extraordinarily sensitive to changes in risk premiums and growth.
So when somebody says it's a quarter of a point hike is not a big deal, what do you say? Is it a big deal?
By somebody, you mean me?
Well, no, I mean lots of people.
I believe the Fed will raise rates next week, and I don't think it's a big deal. Jamie Dimon said that yesterday. Lots of people say that a quarter of a point is no big deal. The impact on the market's not going to be a big deal. It's only a quarter of a point. We're still historically low. Where do you stand on that? Do you actually think that it's a bigger risk than people are factoring in?
What matters is the expectations going forward. Right. Just one rate hike is not important.
Sure.
But what the Fed is always conveying to us is we will hike once, but if the markets goes down, we'll take it away or we'll stop forever. So that doesn't really count as hiking. But the Fed cannot hike.
This whole line of thinking, because it doesn't matter if it's September or December. The rate hikes are going to come unless we have some big slowdown. Most people expect a rate hike. It may not be in September, but most people do expect. What's the odds on December? 60 or 70%?
But that's the problem.
So
if the Fed proceeds,
track it out 60 days.
If the Fed proceeds with rate hikes, the markets will go down very, very hard, just by duration alone.
The series of hikes.
If it's clear, if the market is going to price in a series of hikes, the stock market has to go down very hard. And this is high dividends, this is all equities have got to go down very, very hard. So I don't think it's really possible.
What's a percentage? What's the percentage it would go down? Some think that after the Fed pumped in all of this liquidity into the system and it drove up asset prices, whether it be, let's just say stocks, drove up stock prices by X amount, that has to be unwound when the Fed starts to take that away.
Okay, so if the Fed's going to, what are they going to do? They're going to raise rates 200 basis points? Is that what you mean? If we get there, if we find ourselves there in a year, the markets will be much, much lower. I would argue that the Fed cannot allow, or central banks cannot allow rates to free float, which is a little bit of a crazy statement. We cannot allow this most important market that there is, interest rates.
The most liquid market that there is.
Right, but it's also an important price signal. It's the most important price signal is interest rates, and we can't let it free float. We can't let the discovery process work. If we did that, the markets would be cut in half. The stock market would be cut in half.
Cut in half?
If we let interest rates free float, which would never happen.
Or China's currency, let that free float, and then watch what happens then. That would be a black swan. If China came out tonight and said, we're free floating the renminbi.
Agreed.
Mark, thank you.
My pleasure.
Hope you'll come back. Mark Spitznagel at Universa Investments.
Can I make you a bet, dear coworker?
What kind of bet?
If the Fed does raise rates next Wednesday, will you bring in a live swan?
A live swan?
Yes.
What do you mean? No, where am I going to get a swan?
There's a Costco near my house that has a pond, and they've got swans in the pond. I'm not kidding.
You bring in the swan.
I'll kidnap one of those Costco swans.
Still ahead. Treasury Secretary Jack Lew weighing in on Apple's massive EU tax bill from delivering alpha. Up next, we'll speak with the man who helped bring Apple to Ireland. Our exclusive interview with Martin Shanahan, chairman of IDA Ireland, is next.